They hit silver like a trapdoor. In a matter of hours, we went from $94 to $88. While the Middle East is on fire, energy infrastructure is getting clipped, and China is paying massive premiums for physical metal. That is the headline. And the confusion is the hook. War says go up, oil shocks say go up, Chinese demand says go up, yet someone forced go down. So what actually happened? It wasn't silver demand vanished overnight. It was a regime shift on the screen, and a control move into the New York Open, while the physical market kept telling a different story. I'm going to break down the exact sequence, why gold held up while silver got slammed, what China is signaling right now, what oil's weird behavior is really saying, and the two levels that decide whether this was a shakeout or the start of a deeper flush. Stay with it because every part connects. If you skip around, you'll miss the one detail that turns this from just volatility into someone is telegraphing the next move. Quick intro, then we go straight into the data. All right, here's the play-by-play. Over the weekend, always-on markets were doing what they do, pricing reality while the big Western venues were offline. You had metal proxies and physical-linked instruments trading at levels that were basically screaming, gap higher when the main market opens. And that gap did happen. Silver popped up. Gold pushed up. For a moment it looked clean and simple. Fear bid plus supply shock plus physical premium equals metals up. Then the mood flipped. Not slowly, not politely. Silver got shoved down hard, right into the most psychologically violent zone possible, right before New York really wakes up. That timing matters, because you don't dump a market like that at random. You do it when liquidity is thin enough to move price fast, and when people are most emotionally primed to chase, panic, and hit buttons. Now, before we go conspiracy mode, let's be grown-ups about it. There are two explanations for why silver can get hit while the world looks like it should be bidding it higher. One is macro, the other is mechanics, and both can be true at the same time. Let's start with the macro piece, because it's the cleanest. This is not a growth boom backdrop. This is a supply shock backdrop. And supply shocks don't just spike prices. They also threaten economic activity. Factories don't celebrate when energy costs jump. Shipping doesn't celebrate when routes get risky. Industry doesn't celebrate when uncertainty rises. So in the first wave of fear, money runs to the pure monetary haven. That is gold. Gold doesn't need the economy to be strong. Gold doesn't need manufacturing demand. Gold is the I don't trust the system asset. Silver is different. Silver is half monetary, half industrial. And in some regimes, that industrial side becomes a vulnerability. So when the market shifts from panic bid to growth scare, the order often becomes gold first, silver second. Then the heavier industrial stuff gets hit harder. That's the textbook part. Now here's the mechanical part. And this is where today stops being textbook. A drop this sharp, this fast, right into the New York window doesn't look like natural repositioning. It looks like a forced reset. Because the crowd was leaning one way. Silver had been ripping. The vibes were loud. People were talking in straight lines. $94 means $100 next. That's exactly the moment markets love to punish. Not because the long-term story is dead, but because positioning gets lazy. And lazy positioning is food. So what you saw this morning may have been the oldest move in the book. Run it up enough to load people in, then slam it down enough to kick them out. And once they're shaken, you reverse again, with fewer passengers and better control. That's why this matters. A move like today isn't just about price, it's about psychology. Because the biggest edge in markets isn't knowing the headline. It's knowing how people will behave when the headline hits. Now let's go to China, because if you only watch Western spot price, you miss the most important part of this entire story. China isn't whisper buying. China is acting like a crowd that suddenly decided, we're not waiting. Retail platforms were marking gold at levels that translate to meaningfully above Western spot. And the bigger signal wasn't the number, it was the behavior. Physical outlets reportedly ran low on the type of bars people actually want when they're hoarding value. When the clean investment product dries up, and only the decorative or craft category is left, you're watching demand collide with inventory. That's not a chart pattern, that's a real-world constraint. And here's the scary part for anyone who thinks this is just local excitement. China has huge pools of savings. When a meaningful slice of a population that large tries to rotate at the same time, platforms don't just lag, they seize. Congestion, login failures, checkout errors, all of that is a signal. The flow is real enough to break pipes. Now zoom out again. If China is paying higher real prices for metal than what the Western screen says, what does that mean? It means there is a premium for reality. And premiums are the enemy of manipulation. Because a premium creates arbitrage. Arbitrage creates pressure. Pressure creates delivery stress. Delivery stress forces the paper market to deal with physics. And physics always wins, eventually. This is why you can't analyze this week using only one market. You have to watch the gap between paper price, physical price, and cross-region premiums, because that spread tells you what's being suppressed and what refuses to comply. Now let's talk about oil, because oil is the part that should make you stop scrolling and actually lean in. If you have major energy infrastructure getting hit, if shipping risk rises, if supply routes get threatened, then oil should be up and staying up. Instead, you got a pop and then a fade. That's the weirdness. And when the market does something that looks insane on fundamentals, it usually means one of two things. Either positioning was so extreme that the market needed a flush, or somebody with size is leaning on it to buy time. In other words, the chart isn't denying the world is dangerous. The chart is revealing who is trapped. Because if oil is being held down while the physical risk is held up, you're watching a pressure cooker. And pressure cookers don't release stress gently. They either vent slowly or they blow a gasket. So if you're wondering why silver could get whacked while war headlines are escalating, here's the connection. When oil is unstable, markets fear recession. When markets fear recession, industrial expectations get repriced. Silver gets caught in the middle. Gold benefits. Silver gets judged. That's the regime logic. But the premiums out of Asia are telling you, nice story, the physical bid didn't leave. And that is why today is so important. Because it's not just up or down, it's two markets arguing in public. Now bring it back to the silver chart. You don't need fancy indicators to understand the critical zone. You need one question. Did we just do a violent shakeout that holds support? Or did we break structure and fail the reclaim? Because those are two completely different futures. A shakeout feels like this. Fast drop, emotional selling, then stabilization, then a grind back above the key level. That's the "they wanted you out" script. A structural break looks like this. Drop, weak bounce, failure to reclaim. Then another leg down that forces even the strong hands to question themselves. So what decides which one it is? The reclaim, not your opinion, not your hope, the reclaim. And here's the brutal truth. The market is going to make this feel personal. Because the whole point of a move like today is to turn investors into gamblers, to make you chase candles, to make you revenge trade, to make you either capitulate at the low or FOMO at the high. That's the game. If you want to beat that game, you have to stop reacting to the first punch. You have to wait for the second message. The second message is whether physical spreads stay elevated, whether Asia stays bid, whether the bounce has authority, whether the market reclaims what it broke. Now let's talk about the part nobody wants to say out loud. Silver's move today also smells like liquidity harvesting. Because when a market has a big crowd leaning one way, the cleanest way to create profit is not by being right. It's by being the one who creates the volatility. Volatility is a tax on emotions, and the players who thrive in volatility are not the ones staring at headlines. They're the ones who engineered the exact conditions where your stop gets hit and your conviction breaks. This is why size matters, not because big equals bearish or big equals bullish, but because big equals the ability to move price into zones where retail behaves predictably. Predictable behavior is monetizable. So if you've been wondering why it always feels like the market knows where your pain is, it's because pain is where liquidity lives, and liquidity is what institutions eat. Now I'm going to give you the honest risk case, because if you only hear bullish, you get blindsided. Silver just did a violent move. Violent moves can cascade. If support fails, downside targets open. If the bounce is weak, it's not a recovery, it's a setup for another leg. And if the broader market flips into full risk-off panic, silver's industrial side can continue to weigh on it short-term, even if the long-term thesis stays intact. That's real. You should respect it. But now here's what doesn't change. And it's the reason the $94 to $88 move might actually be the tell. China is still paying up. Physical demand signals didn't vanish. The premium gap still exists. Energy infrastructure risk didn't vanish. And once a market starts to separate paper from physical, That separation rarely closes quietly. It closes violently. Either the paper price snaps upward, or the system rations metal through premiums, delays, and out-of-stock signs. And that's why the most important thing to watch isn't the candle. It's the stress markers around the candle. If spot drops but real-world premiums don't drop, that drop is suspect. If spot drops but inventory doesn't refill, that drop is suspect. If spot drops but Asia refuses to follow, that drop is suspect. This is why the West can slam the screen and still lose the war. Because the screen is a narrative. Metal is a constraint. Now let's talk about the miners, because miners are where the market reveals its true beliefs. When metal moves, miners usually amplify, when the market believes the move is real and durable. If miners lag, it can mean the market thinks the move is temporary, or the market is waiting for confirmation, or the market is pricing political risk and costs, or the market is simply behind. But when miners in one region are screaming higher while miners elsewhere are asleep, that split is a message. It can be an opportunity, or it can be a warning. And the people who win don't guess which it is. They track the follow-through. If the divergence closes with Western miners catching up, that's bullish confirmation. If the divergence closes with metal fading and everyone rolls over, that's risk. So keep your eye on that, because the next phase won't be decided by what social media thinks. It will be decided by whether capital commits. Now, let's put the entire day into one sentence. Gold stayed firm because fear is monetary. Silver got punched because fear is also economic. And the physical premium stayed loud because the real-world bid doesn't care about the paper ambush. That's the regime. Now I want to ask you two questions, and I want you to actually answer in the comments because it tells me how you're reading this. Do you think today's silver dump was mostly macro recession fear, or mostly a deliberate shakeout into the open? And second, if China keeps paying a premium while Western spot gets pushed down, do you believe that ends with paper snapping up, or physical going unavailable? Pick a side. Now here's the part that most people will miss if they only look at today. This wasn't just a price move. This was a stress test. A stress test of who panics. A stress test of which market leads. A stress test of whether the East keeps bidding even when the West slaps. And a stress test of whether oil can be managed even while the underlying reality keeps getting worse. If you understand stress tests, you don't get hypnotized by the first reaction. You wait to see what fails. Because markets don't care what should happen. They care what breaks. So what breaks next? If silver holds support and reclaims, this whole move becomes a textbook shakeout. The kind of shakeout that fuels the next leg because it resets leverage and sentiment. But if silver can't reclaim, if it rolls and starts closing weak, then the door opens to a deeper flush that scares everyone away right before the real move begins. And yes, that's how markets love to do it. They don't reward crowds. They reward patience. Now, a final warning before you go. This week is going to be noisy. Headlines will be loud. Prices will whip. You'll see days that feel like it's over. Then hours later you'll see it's back. That's not randomness. That's warfare. And the only way to survive it is to anchor to the data that doesn't lie. Premiums, inventory, follow-through, reclaims, and whether Asia keeps paying up. If you want more breakdowns like this, fast, no fluff, no wasted time, subscribe so you don't miss the next update. Because the next move isn't going to be announced politely. It's going to arrive when the crowd is confused, and the screen is saying the opposite of reality. And that's exactly when the biggest money gets made. Stay sharp.